All right, well, thanks everyone for joining. Hello and welcome to the Trustvist Talk webinar, the forum that we've set up to engage with senior asset managers and advisors across a broad range of topics. And I'll do a quick introduction and hand it over to the presenters. So brief introduction on Trustvist for those that might not be familiar. Trustvist is the leading outsourcing firm for the financial services industry, supporting over 1,000 clients with over 10 trillion in AUM. We support our clients by providing skilled outsource support across due diligence, business development, portfolio management, data analytics, and other activities. To learn more about us and accessing additional content, feel free to visit our website and follow us on the social media platforms. We also have a Trustvist Talk podcast with a new episode dropping tomorrow, and that's where we have in-depth one-on-one conversations, and you can access that through our website or wherever you access podcasts. And so without further ado, I'd like to thank our panelists for joining us today and introduce the moderator for the panel. Abi, take it away.
Thank you, Amir, and thank you everyone for joining us. We have participants from all over the world, and thank you to our panelists as well. Today's discussion topic is COVID-19 impact on distressed M&A and the outlook for restructuring, highly relevant at this time. And whenever we host a panel discussion like these, we like to get in very varied views, and we certainly have that today with buy-side perspective from both the credit and equity worlds, as well as an advisor, as well as a turnaround executive. So with that, I'll let our panelists introduce themselves in greater detail, as well as their firms. So maybe Hooman, would you like to get us started?
Sure. Thank you for having me this morning, and hi everybody. My name is Hooman Yazhari. For the last 15 years, I have been part of leadership teams of private equity-backed global enterprises that have gone through large-scale restructuring and then renewal and growth, and then successful exits for those private equity firms, working with TPG, Centerbridge, Bain Capital, Soros, and Dell in the aviation, transport, logistics, specialty finance, and industrial spaces. So as you can imagine, those are some of the areas that are going through some pretty difficult times today, and I'm really looking forward to the discussions.
Great. Luke?
Once again, thanks guys for having me as well. Right now I'm with Colbeck Capital. We are a New York-based private equity firm, really specializing in kind of distressed credit and special situation investments. Pretty much all, or 95 to 99% of our investments are through senior secured loans. So a bit more of a credit perspective than Andrew will have on today's discussions, but thanks again for having us, guys.
Andrew?
Hey, thanks, Abby, and hello, everyone. I'm Andrew Flesch, part of Capital View Investment Partners. We are a lower middle market investment firm based in Bethesda, Maryland. We have industry focus on aerospace defense, government contracting, as well as business services, consumer services, and general technology as a whole as well. But our firm has its DNA in special situations investing. We started the firm back in 2017 as being a former investment team out of American Capital from the special situations group there. So we also provide structured debt placements with more equity-like returns. So a DNA in special situations investing, which we apply to the low middle market today, areas of industry focus.
Thank you. And Bill?
Thank you, Abi, and hello, everyone. I'm Bill Henrich. I'm co-chairman of the Getzler-Henrich Companies, which consists both of GH Valens, which provides performance improvement services to portfolio companies of private equity firms, and Getzler-Henrich, who for the past 50 plus years has provided turnaround, workout, crisis management, financial operational restructuring, bankruptcy advisory, and performance improvement services to challenge companies. I've been doing this for approximately 38 years with more than 400 engagements, and having served numerous times as interim CEO, chief restructuring officer, and independent board director to help effectuate maximizing value and recovery for stakeholders.
Great, thank you, Bill. Maybe starting with our CEO, Hooman, would you kindly comment on kind of the role of the CEO and management throughout a period of distress and extreme change, including the current environment we're in, and how that impacts distressed M&A? And what should investors be looking for in the leadership of management teams in situations like these?
Thank you, Avi. The management's role is incredibly important in times like this. There are a million things to do, a tremendous number of priorities, a tremendous sense of urgency, huge uncertainty, existential threats to one's enterprise. And without the right leadership and the right management, I think the risks for businesses falling apart is actually quite high. So if you talk about management, I think they have to think about the now. So protect the enterprise, make sure that the cash and liquidity position is as strong as possible. Look at your customers. What do they need? What can they afford? Is your product still relevant? Look at your suppliers. Are they going to be there in 6 months? And are they still willing to give you credit terms? Look at your cost base. Look at your efficiency. Look at your cash dashboard, right? So that's the cash side. And then look at your people. In today's COVID environment, are they safe? Are they engaged? Are they able to focus on the right priorities? And again, looking at distress and the variety of things that people could be working on. Do they know what they should be doing? Do they know what their focus should be on? Look at your talent. Are you going to nurture them and make sure they stay, or are they at risk of leaving for something better? Look at your compensation plans. Look at the incentives that people have. Are they aligned with the execution strategy that you have? Management should be looking to engage proactively with various stakeholders, communicating and communicating and communicating. Investors and creditors never like to be surprised, so proactively engaged. Credit and capital, I suspect, will be hard to come by over the next 6, 12, 24-month period, right? And the management teams that show an ability to be trusted and competent are the ones who are going to win in actually getting access to that credit. And then management should also be looking for opportunity. We've got this once in a generation disruption here, which, you know, off the back of some very unfortunate displacement and frankly human suffering, will provide opportunities for businesses that have good balance sheets, good management teams, and access to capital. So look, once you've figured out how you save your business and you've figured out the defensive side of it, look how you can go on the offense, because the opportunities are going to be numerous, and I suspect we'll be talking about all of those. And Avi, without meaning to talk too much, management should also be offering leadership. And there's a huge difference between management and leadership, right? The tasks I just mentioned right now are the day-to-day tasks of a good manager. But what we need in times of distress, in times of change, and in times of uncertainty is leadership, right? So good leaders, investors should be looking for leaders that have vision. Investors should be looking for leaders that are able to inspire those around them to buy into and help them to execute the vision. Look at the culture that the leaders have instilled into their organizations. Are the people united around a common purpose? Do they have a sense of safety and shared risk? Do they have a common purpose? Look for people who are able to attract fantastic people. And everyone always says, surround yourself with the best people. And for me, those people are people who are coachable, people who are humble, people who are resilient, people who are honest, and people who are always willing to learn and be open to the change that one needs to embrace, given that the world around us is changing. So there's a starter.
Yeah, and gentlemen, if anyone has anything to add at any time, feel free.
I thought that was I thought Hooman gave a great description, and you can't underscore the leadership quality, right? And very important is that the people around him, the employees, the customers, the vendors, they want to be led. The employees want to be led. They want to understand that there's a direction, that there is a plan. They take solace in that, and they work together towards that plan based on the leadership being provided. And that requires expert communication. And the communication is critical to be not only keenly focused on business continuity, not only be proactive, not only be thoughtful and decisive, but to be able to articulate it to the parties so people understand that there is a direction, they understand the state of play, and they understand what the targets and objectives are as well. So,
maybe if we can turn to the buy-side guys on the panel. Kind of what are you seeing in the last few months, investment opportunities in M&A? What are your views in both the short term and the medium term and for distressed investing? Andrew, if maybe you want to go first?
Sure. Be happy to give a little color on the M&A market. Well, clearly, the buyout side of the M&A market slowed dramatically with the onset of COVID. I think there was a couple of buckets of deals, deals that were directly impacted immediately, things like restaurants and entertainment. Those anything that was in a sale process and in that area, was shut down immediately. And then there were buckets of types of businesses that weren't sure exactly how the impact or how bad it was going to be, and held on and continued on with processes, albeit at a much slower pace. But from what I've seen in the market, the majority of those deals ended up still being out there as hung deals or put on temporary hold, because what we've had right now is a situation where people are still trying to figure out how to price the impact of COVID, and until a buyer is able to price the impact, and until a seller also is willing to price it and accept what that means to evaluation, there's going to be it's going to be hard to bring buyers and sellers together, and we've just seen almost slow to nothing pace from deals that were in the market that were impacted and ultimately didn't get closed, as well as new deal processes being launched. I think on the overall M&A side, we're already starting to see some of the, especially more on the cleaner deal side. I've been talking to bankers that they're starting to get interest from their clients about either restarting or starting to prepare to bring things back out. Companies that have a very valid case as to how they're able to survive and react to COVID, and companies that had intended to transact but were holding off. I think you'll see clean deals and specifically deals that are attractive to strategics coming out sooner rather than later. I would say over the next 30 to 60 days, I would anticipate an influx of processes on that side. Specifically to our panel topic on the distressed M&A side, that is more, Bill and other folks who are restructuring professionals on the line can tell you those types of transactions are really more timing driven, and people transact when they have to. And so, when the liquidity provided by the government stimulus and the folks that drew down on the revolvers, once that starts to run out, companies that are good businesses but had a non-recurring but still ongoing impact of COVID are going to have to make tough decisions, and that is going to be the time frame where you're going to start to see more distressed M&A. You've got large bankruptcies going on like Hertz and others already, but the true distressed M&A sales, I think we're still probably about 30 to 60 days off where the real opportunities are going to be for folks like myself and Luke from an investment standpoint.
Yeah, I'd say, and to Andrew's point, our businesses are a little different. Obviously being on the credit side, we've seen, we had a big uptick in deals kind of in the March, April, May time period. But those were really the industries that were already kind of dying. That was just kind of COVID was more of an accelerant than a change agent for those industries, like, brick and mortar retail, some trucking deals, coal. We saw a lot of restaurants as well, but, they already had pre-existing conditions. So, they were just rushed into a distressed financing need at an earlier date. Or if they were planning on doing an acquisition and that fell through, and then they had, a short-term liquidity crunch. So we saw kind of a big uptick during April and May, right kind of when the secondaries market was really taking off for everybody buying the public debt. Then that kind of slowed down as federal funding came in, companies were drawing down on their revolvers. You're starting to see it pick back up again, like Andrew was saying. But I think, as many of these businesses run out of cash, that they drew down, federal funding, they're going to burn through that in 2 to 3 months. And then you really start reopening these businesses, there's going to be a larger cash drag than when these were sitting idle. So it's going to accelerate. A lot of these guys, budget a much lower cash burn. We always joke, look, everything takes 2 times as long and is 2 times as expensive as you planned. And so we think a lot of guys are going to end up at the end of the road, not planning on needing money, but think like Q3, Q4, there'll probably, we think, a lot more deal flow. And additionally, the commercial banks, looking to sell off paper or get rid of loans that, they need to get off their books. We've kind of seen that a lot of these commercial lenders haven't really gotten the valuations done over the past 3 to 4 months. 1, because it's difficult to, and 2, because they don't want to. You don't really want to take that mark to market right now, because it's hard to value inventory if you don't know what what COVID's going to be doing in 4 months. It really does kind of throw off the valuation. So we've seen they've been pushing out these valuations, so they're not marking to market on kind of the new adjusted value. So we think they're going to have to start writing those down and end up selling those off the book later in the year as well. So with Andrew, we're in agreement. End of the year to beginning next year, we should see more deal flow.
Yeah, and Bill, kind of picking up where Andrew left off, we have seen more bankruptcies recently, but restructurings tend to follow those, and we haven't seen as many of those actively. How have you kind of seen that market developing? What's keeping you guys busy?
Well, we are extremely busy. But the restructurings are happening in 2 forms, right? It's both an operational restructuring, largely because of necessity, and as well as the financial restructuring, also because of necessity and their ability to be able to access capital. And, to the extent companies weren't forced to entirely shut down during COVID, even those that were, they sought to preserve cash and align their cost structures to the new normal and find ways to obtain or increase revenue through other means, internet or other delivery methods, to maximize whatever cash inflow that they could to cover their cost base, and as well as obviously securing the government subsidy programs. The companies that shut down operations entirely, their fate to date has been dependent solely on their financial health and liquidity pre-COVID, and the access to government program subsidies and the availability on lines of credit and equity support. But as it's already been said, that will only last, for so long. So we've seen the bankruptcies of retailers, restaurant chains, travel and entertainment enterprises, who were all hardest hit by COVID. And they've had, in some cases, especially if they were distressed pre-COVID, they've had little choice but to file, in the absence of adequate existing capital or access to capital. And as said, many are just hanging on because of the PPP funds that they were able to secure or the other programs. But restructurings are happening, and they're plentiful through credit agreement workouts are occurring routinely. Balance sheet restructurings are occurring to the extent fulcrum securities are willing to take on responsibility for funding future working capital needs, which certainly is uncertain. Some clients have said, isn't this an exercise in futility? And the answer is, to a certain extent, yes, but it's necessary. You need to understand at least the parameters of what your working capital requirements are going forward. Your lender wants to know what your needs are. Your equity support wants to understand, are you going to run out of cash? If so, when and how much do you need, and for how long, and whether that's readily available. So distressed investors as well are evaluating the market opportunities. I mean, financial projections today are appropriately discounted. Valuation multiples are naturally depressed given the economic uncertainty. But on the flip side, that provides opportunities for the distressed investors. Many retailers that the brick and mortar that we were talking about, distressed prior to COVID and now have filed Chapter 11, have gone straight to liquidation. The Models, the Art Van Furniture, the Pier 1 Imports, and others are actively paring unprofitable stores, conserving cash for the return of profitable stores, and or they're filing bankruptcy to obtain relief on the antecedent debt and to help force the negotiations with landlords on future rent concessions to the extent that they may or may not be available. So there's enormous activity that is ongoing. And I think, as we said, this is just the tip of the iceberg. As the PPP funds run out, and as capital runs thin, you'll see that it will increase at a more accelerated pace. Because the reality is, we still don't know, how long that our depressed top line is going to continue. And if these enterprises can't maximize their top line, they still have a fixed cost base plus a variable cost base to incur to be able to even operate at the reduced levels. And for most, that's still creating losses for them, albeit maybe at a somewhat reduced state when they had no income coming in to cover their fixed cost base. So it's still problematic, but the restructurings are occurring and they'll increase as we move along.
Great. Now, maybe looking at this in some historical context, I think we have folks both in the audience and on the panel of different vintages. I started this then 9 months before Lehman Brothers collapse, and I started my career in 2001 in tech investment banking. So, been through a few of these. But it's been 11 years now since the last crisis. So for a lot of folks, this is their first crisis of this nature. And Bill, I think you might have lost count of how many you've been through.
Is that because I may be the oldest on the panel? Is that why you're starting? I'm just asking. Anyway.
The most experienced is what we'll say.
There we go. Okay, because I've lived through it. Okay. Now, and look, I think 2008 was less damaging to business. We saw 15 to 30% drops on top line. Where today we're seeing 50 to 100% declines on top line. But back then the financial institutions were hurting because of the mortgage crisis, the subprime crisis, and the like. The issues that we had previously. So financial institutions were hurting, and we saw a lot of extend and pretend, and a lot that just, if companies didn't get ahead of the curve on fixing their cost structures, they went by the wayside. If they got ahead of the curve, they were able to survive with the moratoriums that were provided by the by the lenders. In 2020, we're seeing the severely damage to the businesses, but for the most part, there's ample liquidity in the marketplace. Maybe not true for every fund out there, but there's relatively ample liquidity, and financial institutions are healthy, but they're all trying to preserve liquidity because there was the run on drawing down the credit lines. There was the demand for additional support. 2008. We had a lot of operational concerns and balance sheet fixes. 2020, certain sponsors are limited on their ability or willingness to reinvest in existing portfolio companies, which again presents opportunity for investors that have liquidity. The way I kind of look at it, in the past, people looked for the operational fix, where there was weak management or there was opportunity for operational improvement for the value creation premise. And today, I think the opportunity exists for investors that actually have ample capital to fill the gap to return intrinsically good businesses to become healthy again. So I think those are some of the decisions that I see.
Hey, Abi.
Yeah, sorry, go ahead, Hooman.
I just, if I may add to Bill's points, I think this time around, yes, the banks are healthier, but it's a much more holistic hit to our global economy than just the aviation sector where I was right after 9/11. and this may come back. We have no idea how many waves of COVID there are going to be. So the multiplicity of the shocks that we may get and the holistic nature that I think makes it harder for the lenders to just say, you know what, we're going to repossess this and flip it because there's other people who can buy it. If the whole industry and the whole economy is suffering through COVID shutdown, then it makes that dynamic different and maybe even better for the borrowers because they know that banks are going to be even more reticent to step in. The other thing I think that I feel is different this time round is we were going through a wave of awareness as a society of the responsibilities and the effects of business. So ESG was gaining a lot of momentum in its infancy. I think what COVID may do, and it may not, right? It may squash ESG and it may squash people's views on what actually the role of business is holistically. But I think what it's doing, and you see the riots on the streets that we have today and the protests, people are going to hold members of society accountable for doing the right thing, for injustice, for ruining the environment, for not treating their employees or their stakeholders fairly. And I think that this crisis has accelerated that in many ways. And I think businesses should holistically look at what they're going to do when they come back, in addition to being profitable, but they need to look at being resilient and being responsible corporate citizens.
Yeah, I know in business school, they talk about management's focus on maximizing shareholder value. And I think that phrase has very much changed to maximizing stakeholder value, with the definition of stakeholder being much more broad than just the shareholders to include employees, customers, and the community. Andrew, I think you were about to say something.
Yeah, I was just going to weigh in from kind of an investor standpoint. You know, I do have the perspective going back through the Great Recession and you know, the dot-com downturn in 01, and I think, I mean, for me, relative to 2008, is the cause of the crisis being 2008 financial versus today an external factor with the pandemic. The big difference for me is from an investor standpoint, it really has created a world of winners and losers around potential business models that's fundamentally different than 2008, where you had, outside of fix and buyers and distressed investors, it was a more across the board, as albeit, as Bill pointed out, not as dramatic and deep, but across the board kind of depression that you were looking at from an investment standpoint. So I think for investors looking to decide on opportunities going forward, it's really on a case-by-case basis, and you combo that with the influx of, well, not the influx, the availability of capital. I would argue that that's going to be a very big difference relative to how companies are able to rebound. That I think there is, for what we're seeing, is there's an appetite for investors to put capital to work and realizing what they see as a potential opportunity in this current environment. I think that is going to be more of a catalyst than what relative to 2008, where there was A, lack of capital, and B, the bar was raised prohibitively high by investors and lenders to just, it led to almost a slowing down to a halt that took years to recover from. Whereas in this environment, I see people actively desiring to put capital to work and to take advantage of the opportunity that COVID is relating and has created, and the being able to parse through those businesses with some winners and some losers and invest in that world. I think that is going to cause clearly a faster rebound relative to where we're in 2008.
Great. Just an aside, we're going to put up some polling questions for the audience, so feel free to participate in those. And I have gotten a couple questions from the audience as well, so please just send any questions you may have in the chat, and we'll get to those at the end of this conversation. Follow up on what we've been talking about the current environment and when things might turn. We see from the audience, most people feel it's going to be 12 to 24 months that we we'll return to pre-COVID levels of deal flow. So a few optimists in the next 3 to 6 months. I hope they're right, but we shall see. Now, there's certainly a lot of LP interest in investors that are experienced with distressed M&A, and given that this strategy is likely to only gain popularity, and as Hooman suggested that this period might stretch out even further, how do you foresee competition as investors when it comes to acquisition of distressed assets? Andrew or Luke?
Yeah, I can hop in on this one first. You know, I was reading an article the other day that they were saying, you know, distressed hasn't been popular for 10 years and now it's in vogue. You know, you see a lot of press about, you know, the guys raising funds, you know, Apollo, GSO, Fortress, Carlyle, Oaktree, they're all raising these massive funds. Kind of in our world, how we view it is there are really only 8 to 10 guys that are raising these large distressed funds, and you know they're raising at billion-dollar clips. Well, they're not going to invest at, you know, $40 to $50 million clips. They're just not set up for doing that much volume. They're going to do, you know, $200 million deals, maybe a few clubbed up deals with some of the other big guys. So they, you know, we don't really view them as competition. Like Colbeck, as you know, our deal size or our target deal size is about 50 million to 150 million. Sometimes, you know, we'll go down to 20, sometimes we'll go up to, you know, a couple hundred. But generally speaking, all the big, you know, LPs, you know, putting money in and all the big funds that you see in the news aren't really competition for us. Actually, unlike call it the distressed credit side pre-COVID, our biggest competitors were direct lending funds, BDCs, you know, credit hedge funds, and, you know, occasionally family offices, occasionally PE funds where it's looking more like structured equity type deal. And, you know, we're just doing it through a senior secured loan. But you know, a lot of those guys are set up as multi-strat funds. They do a lot of volume. They're not really set up as, you know, a distressed fund, like, or, you know, as distressed investors. They can't take a look and take the time to go deep enough on these really hairy, complex deals. They're just looking to, you know, print 25 deals a year and put money to work and then collect management fees. You know, that's kind of how a lot of them were structured before. And so, you know, a lot of those covenant light deals, you know, high single digit returns, that's not really the space we play in. And a lot of those firms like the BDCs, they're struggling. You know, they're really licking their wounds after the past few months. So we actually have seen less competition. You know, a lot of the firms we typically had competed with are dealing with portfolio issues and not working on any new originations. Some specifically only targeted the publics and the secondary trades, right? You know, when the market tanked back in April and May, but less so on the direct, you know, primary new origination front. So we're seeing less competition actually right now. Really, our biggest competition has been the U.S. government with federal funding. So, you know, that's been a pain. But yeah, no, look, there's going to be more competition. More funds are going to, you know, more firms are going to raise funds for the, you know, the specific sector. There's going to be more money raised to put to work. More funds are going to pop up, but there are also a lot more deals. So, you know, I kind of would tend to think that it's kind of going to be about the same for Colbeck specifically. But you know, generally, I'd say more competition, but also more deals.
What's the tenor of the loan-to-own shops today? Are they being cautious, or are they licking their chops?
You know, we don't find that many loan-to-own shops anymore, kind of in the 50 to 150 range, that truly are trying to loan, unless it's, you know, a loan-to-own on just the pure asset, like an ABL player that is really trying to loan-to-own that asset because they know it has, you know, good value, good alternative use. I can make a play because the company, you know, is in a sector that's, you know, has headline risk. I can get in, I can take that those trucks or that equipment and sell it to, you know, the waste industry or something at a premium. So it's, you know, I see less from the loan-to-own shops, the vulture shops right now, out of trying to own the business. we're not really set up to run businesses. So that's the last thing we want to do. So, we'll definitely charge you if you breach covenants, but we're not trying to seize the business. Yeah. I've already called Hooman. Don't worry, we're setting that up now. But yeah, no, we're not trying to take the business. We're really, the last thing we want is to do that, just because we're not set up to manage an operating company. The asset side of things is a little different, because that you can underwrite your loan to value on that collateral, and you would first look to move to sell that collateral if there were any issues. But out of the loan to own kind of operational type structure of things, Bill, I see less of it historically. Maybe more now because there's more opportunity, but.
Right.
One of the things that's kind of, I'm sorry, Andrew.
Oh no, I was just going to weigh in on the lower middle market side, on the buyout side. I would echo what Luke had said, is there's a significant amount of investor interest and capital that has flowed into the space over the last 2 years. You've seen a number of new funds, but I think it's very challenging for a buyout firm that has traditionally focused on performing or middle of the road deals to just pivot to a distressed or turnaround type of situation. So I think there is just a fundamental infrastructure issue that there's going to be more capital looking for opportunities, and I think there are going to be more opportunities in the restricting point is really going to be the folks like Bill and investors that have the appetite to own companies that have to work through issues and get through liquidity situations. So from that standpoint, I think there is some decent competition, but there is going to be more than enough supply to go around relative to the scale of the infrastructure that exists to access that.
Right, and it's really a willingness to accept the uncertainty of what that investment may actually entail. They'll protect it, with their purchase price, but in today's environment, when it's more difficult to understand, the length of the depressed market, because of COVID, and the fact that it's uncertain whether there's another wave, when does a vaccine come out, what have you, an investor has to have a stomach for and a willingness to be able to set the capital aside to be able to fund that as necessary.
Mm-hmm. Can't do desktop diligence on a lot of these deals.
No.
It just doesn't work like that.
No,
so,
not anymore.
It's not that easy, sadly.
I mean, and as I said before, it's difficult for the companies themselves today, right? Because they're trying to assess for themselves. The basic questions that lenders ask, the companies are asking, investors are asking: do we run out of money? When? How much? And how long will that last, right? And those are in the past. If you understood what the operational fix was going to be, you could guesstimate with relative confidence what that was. In today's environment, because of the external forces that are creating this, this economic state, it's much more difficult to do that. So you have a higher degree of uncertainty and error in what you're doing, but you still have to try to, as best as you can, put some brackets around it to get a sense as to what that range is, based on where you are today, where you think things are going, listening to what's going to happen. And even then, you don't know, is a vaccine going to be in January, or is it going to be next fall, right? I mean.
Yeah. Great. Amir, if you could put up the next polling question, which is going to be speaking kind of about the different sectors. So as I mentioned, I started my career in tech banking and was able to pivot out that into telecom in the early aughts, right, when that was nothing but restructuring, and then went into media, private equity, and primarily traditional media, which broadcast and radio went through restructuring, and completely agree that it's very hard in restructure situations not to be able to go and touch and feel the assets and see what's going on the ground. So maybe right now we can talk about specific sectors that have been hit the hardest in this pandemic. Where are you guys seeing the most difficulty and perhaps opportunity as well? And how are potential buyers positioning themselves to take advantage of the opportunities that might arise?
Abi, I would only comment one thing. You forgot one other choice, which is all of the above.
I purposely left that out.
Position.
But go ahead. Sorry.
Yeah, no. So just for anyone on the panel, like Where do you guys think are, obviously everyone's going to have challenges. Where do you think is going to be the most hard hit? Where are you going to see the opportunities as buyers?
Well, look,
Go ahead.
go ahead.
Yeah. Go.
Well, I was going to say, look, as a former, retail, restaurant chains, travel, hospitality-related companies, healthcare enterprises have been the hardest hit. And long-term, the intrinsic values of most businesses are likely intact. But as we've said repeatedly, the lengths of the road to recovery differ, and they're dependent on the social distancing restrictions, consumer demand, their confidence to interact, the future waves of the virus, the retention of antibodies for immunity, what's determined, the timing of a vaccine, and all those things are unknown. Healthcare is, the healthcare sector is not uniform. The moratorium on elective procedures have basically gutted the revenue and the profit and whatever profits they were making or margin they were making, while costs have been consistent and the labor has been stressed beyond reasonable means and expectations. And so the business is dependent upon customers also with a demographic profile that have been hardest hit monetarily will also suffer. Let's not forget there are 40 million people that, on the unemployment rolls, although I think they came out today and I don't know exactly I didn't hear what it said, but those people have little discretionary income. So, retail, we saw the early demise of those that were stressed and distressed pre-COVID, and we will continue to see others as the monies as the cash runs out, and the return to normalcy elongates. And the problem is the risk and uncertainty of the future cash flows negatively impacts valuations. Buyers are compensated for greater uncertainty through price reductions. Valuations are further reduced by the working capital that's got to be put up. Thus, for businesses with sound intrinsic value, generally healthy pre-COVID, struggling for capital to fund the bridge presents buyers with meaningful opportunity. But the restructuring will be very heavily hit in especially the retail, the restaurant chain, the travel sectors, because I think that's going to be where consumer confidence and demand will, until especially a vaccine is created, they will remain cautious despite some of the images that we see, of folks going to the beaches and the like. So, and by the way, the shop, a lot of the experiences that we see today in terms of how businesses have struggled to continue to provide goods and services to consumers, a lot of that will continue, right? The curbside deliveries, the regular deliveries, a lot of that will remain to some degree. So
yeah, I'd agree with Bill that a lot of the trends that were accelerated pre-COVID are probably here to stay. With regard to online delivery and things like telecommuting, that are going to fundamentally change the business models. And as Bill noted, you have to have something to restructure around. I think certain, I would say, especially retail and commercial real estate, the industries have just fundamentally changed. I don't think you'll get some rebound to the way we were prior, but I think there's some permanent component to that consumers are going to continue to buy online more. It's just accelerated that factor, and I think employers are going to be more open to reducing their rent costs and allowing employees to telecommute. I think on the aviation side, that was one of the other industries that you had noted. I do see, and love to hear Hooman's view on this, but I do see a return to the 2020 levels. I wish I could tell you how quickly and when. That's the part that we're all still figuring out. But I firmly believe, unlike retail, where there might have been a permanent disruption, I believe on the aviation side, people will be getting back on airplanes, and even to the extent that from a selling standpoint, people are completing sales over Zoom and online, or phone calls today. I think once we do have a vaccine and I think people are going to continue to travel, and I think the aviation sector, more so than some of these other business models, has something that you can bridge to and restructure around. And we obviously it's an area of focus for us, but we do see a lot of opportunities in that space.
It would be interesting to put up a pop-up question. I don't know whether you have the ability to do it, but in what time frame are people willing to get back on an airplane? Because this group is a highly, I'm making an assumption, is probably a highly traveled group. I know I was on a plane virtually every week or every other week minimally. Before I haven't stepped on a plane, and I just drove from New York to Florida last Saturday, which I wouldn't have done normally, right? So
when people at the lounges know you on a first name basis, something's wrong.
Right. So yeah, well, they do actually. the Delta Sky Club. So it would be the responses would be interesting to see what time frame before somebody would step back on a plane.
Andrew, I'll agree with your optimism. I think the aviation sector is the glue in many ways that keeps our global planet together. And people will Zoom and see each other on the video, but the pent-up demand will continue to increase. Bill's point is correct too. I was on a plane probably every week before COVID and haven't touched one, and I'm not quite sure when I would be comfortable getting back on a plane. I think the problem with aviation is the incredible capital intensity that it needs, and so you've got 28,000 commercial aircraft flying around right now. Flying around 9 weeks ago. The question is 2021, 2022, 2023, how many of that 28,000 are going to be airborne? And do we go to 3/4 of the fleet in 2 years? And what happens to the other quarter of that fleet? Do they get parted out? Do they get retired? You can see certain aviation assets like A380s or like the older 75, 76 assets being either retired, parted out, or converted into freighters or whatever it is. So certain assets in that sector won't come back. Certain airlines in that sector won't come back. If you've got a flag on your tail, you'll probably get bailed out, and you may even get bailed out twice. But if you're like a low-cost carrier owned by private equity, the third airline of a country, no one's going to bail you out. And whether or not new investors decide to have the guts to come back in and pull you out of a bankruptcy process, I don't know. So I think you have to be very, very selective. But if you look at what happened to aircraft prices right after 9/11, you had certain assets go down by 20 to 30% in the 12 months following 9/11. Certain assets go down by 40 to 60%. Those were the wide-body aircraft. And actually, 24 months after 9/11, many of those assets had bounced back by, only to be 10% below where they were, right? So if you have the guts to go in and buy these big, expensive, shiny assets at the right time in the cycle, there's a lot of money to be made in aviation. Yeah. And I'm tremendously excited by those opportunities. But, the old joke in aviation is if you want to become a millionaire, you start off as a billionaire and go buy an airline. So it's a very difficult industry in which to make money.
Well,
people continue to try.
Yeah,
yes.
Yeah. We've actually, I was talking to a guy over the weekend about it. We are taking a look at an airline right now, but actually looked at, the hot topics, cruise ships and hotels, and, everybody, they look like great investments, but it's a very hard deal to make because, like Bill was saying, really everybody was saying it, but Bill harped on it a few times, time. I mean, time is not free. So you have these big, beautiful, shiny assets, yes. With a plane, you have to park it somewhere and you have to pay for that. With a ship, a cruise ship, you have to park it in a port and you have to keep it hot idled. So that can be anywhere from $250,000 to $500,000 per ship. And then, so if you're going into a deal, these ships are usually worth $50 million on the low end, that's like tertiary, secondary market, or $1 billion for a brand new ship. I mean, these things have a lot of value. Now, the scrap value is your only other viewpoint on kind of the downside. That's your floor, I guess you'd say. But even the floor dropped with COVID, where it was about $350 per ton. Now it's down to, 250 to 290 per ton for scrap. So we had the biggest issue with it is we were saying like, look, okay, we can't necessarily say what the cruising industry will look like when it comes back. But the one thing we don't know is how long it'll take to get there. So you can get upside down very quickly because you're going to have to continue to feed the working capital to keep these assets hot idled. You're going to have to keep this company alive, but when do you make the decision to stop? It's a very difficult decision because then you're seizing assets and you're selling them. But the whole reason you're in that situation is because the whole industry is screwed. So it's really wrong way risk because when you go to sell the things, most likely multiple other lenders are doing the same thing. And then most other lenders are probably running into the same, market prices. And so they're looking at scrap. And so scrap, the supply of scrap. So it's a hard decision to make because time is really the only mitigant that I can really see for hotels and cruise lines, for public sentiment to get back to where you feel comfortable getting on one of these things. Because they're both great industries before. I mean, the two specific deals we were looking at, they, $50 and $85 million hotels making, 5 to 10 million in EBITDA a year, and, ships doing about the same. Great management teams, extremely valuable collateral back in the day, but now you just don't know. It's wrong way risk. And then the problem also with those is seasonality. So if they, if people get comfortable to get back on a cruise in 18 months, but it's not in season, you could be out another 6 more months past that. Or same with, hotels in certain areas of the world. So it's just, it's very hard. We had a very difficult time taking a view on those because even if that all goes right, in a hurricane hits or you have some other pandemic hit, then, you're right back at square one.
Yeah. So if we can pivot a little bit to talk about the actual restructuring process and the tools that you have at your discretion. At Trustvist, we have a data intelligence group, a team of data analysts, engineers, and scientists that a lot of our private equity clients have us work with portfolio companies to try to organize large volumes of data to see patterns, trends, do predictive and prescriptive analytics. Bill and Hooman, what are you guys seeing as far as the tools and how is big data playing a part in the restructuring process?
Well, I mean, they've been around for a long time, right? On its most basic level, as I mentioned before, their credit agreement restructuring is going on. You're trying to create moratorium on principal payments or interest payments for a period of time, extend the time for repayment, or try to get some relief on restructuring balance sheet conversion to equity to reduce the debt burden. But obviously those kinds of concessions come at a cost as well, whether it be additional fees or additional collateral or heightened reporting, different operational benchmarks, retention of professionals, what have you. For those that are in more dire straits, where existing capital is insufficient and it needs an infusion and another party for ownership, people are looking at out-of-court transactions, or Article 9 sales, or looking at Chapter 11s, and typically, when you talk about the use of bankruptcy, any sound professional in our world will tell you that typically Chapter 11 should be the last resort and utilized only if it's either strategically beneficial or necessary. And to the extent that if you can pursue what you're seeking to do inside of bankruptcy, if you can accomplish that outside of a bankruptcy without incurring the administrative cost associated with the bankruptcy, then you should attempt to do that, assuming you have the time and capital sufficient to be able to accomplish that, that strategy. And there are a whole lot of considerations as to which path you pursue, and a lot of that is dependent upon, the viability of the business, the financial condition of the business, the resources available, as I mentioned, to even pursue a process, the pressures that are being applied, or the objectives of the secured lender or unsecured creditors is the secured lender looking for immediate repayment through a sale or loan to own, as we talked about before, or unsecured? So are they curtailing supply because they're concerned about your financial stability and therefore and non-payment risk and therefore it's harming the business? What's the size of the company and the complexity of the capital structure? Can consensus be easily reached on a restructuring? What's the number and concentration of unsecured creditors? Can you actually achieve a moratorium and a repayment schemes in sufficient amount because you have a high concentration of creditors, or is it widespread and fragmented where it becomes much more difficult to be able to accomplish getting sufficient moratorium? What's the saleability and the ease of soliciting interest in the assets? And most important, from a bankruptcy standpoint, when I talk about is it strategically beneficial, the use of the automatic stay, the rejection of executory contracts, which we see retailers utilizing routinely, to be able to assume but reject those locations that have unfavorable, that are unprofitable or unfavorable lease conditions, and they're not being able to get concessions. The limitation of landlord claims, to be from a lease rejection mitigation strategy. And it's also a useful tool to facilitate preserving critical vendors and contract customers. And the ultimate question, is a sale immediately necessary to preserve the value of the business? And frankly, that's a question posed to a lot of buyers, especially in this time, and especially given the losses and debts that have been accumulated in part either before COVID or during COVID. Necessarily, there's a benefit from the automatic stay to compromise those claims, and a buyer wants to buy free and clear of liens and encumbrances. So as time passes and revenues haven't increased sufficiently above the business's fixed costs, or we still see suppressed demand, the bankruptcies will likely rise. You'll see a greater frequency and be utilized as a tool more often. But that's just a quick summary of alternative approaches of dealing with businesses that remain viable. There are other approaches dealing with those that aren't viable and how to get value out of assets, but that's not what we're really talking about here.
And Hooman, maybe more specific for you, how can a board of directors or owners be helpful to an enterprise as they emerge from times of distress or a change of ownership? And what are the critical issues faced by these type of businesses that need to be on the radar of the stakeholders?
A board's duties, composition, and workload is very different, I think, when they are leading or serving a business that has just come out of bankruptcy than a business that's business as usual, right? And that seems like a pretty obvious statement, but it's very, very true. I've served on a board recently of a global helicopter enterprise that has left bankruptcy, and the time commitment is huge because the board has to realize that this is a business that has just gone through the shell shock of a Chapter 11. It's a management team that's exhausted. It's a management team that has really been distracted from the operational and renewal task that they have and being sucked into this cage fight of a Chapter 11. So they are exhausted. They are looking for leadership and direction in many ways. And the board, which sometimes could be a fresh set of non-executives or a fresh set of private equity folks who have bought this business, are full of energy, raring to go, expecting management to be as raring to go as they are. And I think they have to realize that these are people who probably watched the business unravel, sat there and looked and in confusion, didn't know what to do. Then they called in the advisors like Bill. And then they got their eyes open to a whole world that no one actually outside the restructuring world knew existed. And had to cope with it. So boards need to be aware that the talent of a business is important, that they should be the right people, and if they aren't the right people to take the business to its next stage of renewal, reinvention, and growth, then they should be changed out. They should look at the incentive plans and again, make sure that they're there to keep the right people in place doing the right things for the medium to long term. They should do a full strategic review, understand whether the issues that took the business into a position of distress are still there. And with a fixed balance sheet and new capital, what else do they need to fix the operational and the cost and the product and the various other issues specific to a business, but also look at the competition and the market around them and help the business see those opportunities, identify them, and go on. And then there's all the other issues that I mentioned before, which a board needs to be looking at a super high level, which are the social issues and the COVID issues and the resilience issues and all those issues beyond just shareholder return, which I think boards will need to look at.
Thank you. Amir, can you put up maybe the final polling questions? We've just got a little bit of time left. Bill, given the uncertainty today, how do you view the effectiveness of Chapter 11s, and which situations are these better suited to? And related to that, we have a question from the audience on Chapter 11s as well. What percentage of large companies actually emerge from Chapter 11 to resume business successfully, even if in a smaller state? And typically, how long does a large company take to emerge from a Chapter 11 process?
That's a loaded question. I mean, I think that the initial part of your question I answered just prior to Hooman's last answer. In terms of the effectiveness of bankruptcy and the considerations that drive a strategy, whether or not you utilize a bankruptcy. So I, in a desire not to be repetitive, let me focus on the question. Look. Small companies have a harder time to get through Chapter 11 because of the high administrative cost, but everything is circumstance dependent. Large companies can certainly emerge, but the timing is really dependent upon how much work was done pre-filing and what the desired exit strategy is. And what are the relationship and complexities among the stakeholders, whether it's going to be a litigious chapter proceeding or not. So, for example, in the past you've had large companies that have done a lot of pre-planning. Let's use retailers as an example, and let's exclude COVID for the moment because it creates a different complication, but to the extent that they've done all the appropriate pre-planning in terms of understanding store profitability, four-wall cash flow, which stores they want to keep, which not, how do they want to reduce their corporate overhead structure, to support a smaller footprint. If they did all that work ahead of time, they can perhaps get through, and they've actually done some pre-arrangement of the bankruptcy in terms of a plan of reorganization, with their creditors. It can be done in a short period, in a lesser period of time. I mean, we took Diesel USA in and out of bankruptcy in 38 days, which was extraordinarily fast, reducing their US footprint, modifying some arrangements with landlords. And so that was extremely quick. We have other Chapter 11s ongoing today, which I won't comment on, but we look to try to get them to exit in a 90 day time frame. If a lot of that pre-arrangement and there's animosity on the front end or disagreement in terms of what the exit strategy is, then a bankruptcy can take a longer period of time. If it's a sale case, which many bankruptcies today are, there's usually and that's well understood going in, and that's because that's essentially the exit strategy. All that really depends how much of the company how much of the market solicitation process occurred pre-petition as opposed to post-petition. If the company was marketed meaningfully on a pre-petition basis, again, you could probably get out of, even on a large company, get in and out of Chapter 11, 90, 120, 150 days, somewhere in that time frame. If you didn't do the if you didn't do the sale process, if you didn't do a lot of marketing on a pre-petition basis, it could be longer. But again, other factors: what's the liquidity of the company? How is the case being financed? And what's the willingness of parties? What's the level of capital of DIP financing or cash collateral available to be, and how long do parties want to see that marketing process occur, the company in Chapter 11? That will obviously, the ability to be able to finance the case and the available capital for that is a driver as to the timing of a case as well. So there are a number of factors, and those are just some of them. Hopefully that gives the questioner a flavor as to some of the issues that drive timing.
Abi, from a management perspective, Chapter 11 gives you this incredible opportunity to restructure your business in a new shape that you'd hope it would look like. But given how complex it is, how expensive it is, it gives you a machete to take to your business. It doesn't give you a scalpel. So the more work people have done up front, as Bill just said, the more that machete turns into a more refined tool to cut out bits of your business that you don't want to have on an ongoing basis. But the less work you've done, the less precise you can be. So if you compare it to the other systems that we have, like I lived in Europe for a long time, there if you go insolvent, an administrator takes it over and usually just chops bits off and sells it or liquidates it. Here you get this reset button, you get this protection of the court, and you are given every chance to emerge as the phoenix from the flames. And you got to do it quickly, and you got to realize that you prioritize, cut the bits out that you can and you don't need, and get the hell out quickly with a plan to continue that transformation post Chapter 11.
Right. Maybe the final question for all the panelists, just 1 to 2 minutes, kind of to talk about what the world is going to be like post-pandemic. What are the long-term changes in M&A that you see happening, and specifically how, as management teams or investors, people can position themselves for a reopening of the economy.
Well, go ahead. I'm first. Bill.
Who's got the crystal ball?
I don't care. No, there's no look. There are more questions than answers, right? I mean, that's really the issue, and the questions are, what's for a company, what's the working capital position, in particular because of the uncharted waters that you're, following a mandated economic, shutdown. Who's the customer base, and how will they return? And what are the limitations on revenue, created by COVID, the labor force availability following layoffs, furloughs, fear of gathering in groups, the availability of skilled workers, and how you have to, and all the additional protections that you have to put into the workplace to be able to keep them safe, which is paramount. Your production capacity, both pre and post COVID. The changes that social distancing is required actually in the workplace, the additional costs that are incurred to create a safe environment, the changes in the supply chain, the veracity of suppliers, the willingness of vendors to extend trade credit. And by the way, was there disruption in the supply chain? What's the financial stability of your suppliers, and how does that change your business? How you deal from a capital structure standpoint, what's the ramp up period, from reopening. So do we have the answers to all this? No, they just have to attack it one by one and try as best. Cash is king, preserve cash, try to maximize be creative, try to maximize your revenue opportunities. I'm involved, and again, I can't say we just filed last Friday night, but in a healthcare retail setting, a PPM for elective procedures, and I must say I was impressed by the creativity of the management team. you know, it was really important that management teams took that time to reevaluate all the elements of their market strategy, and if they took the time to figure out what the sales and marketing efforts were needed to expedite the revenue rebound, and how to shore up their organizations from a management standpoint, from an operational process standpoint, and the like. If they took the time to do that, and it's not too late, they should always continue to be focused on continuous improvement. But a lot of that creativity, to the extent that enabled the rebound or the reopening as we're going through now, to start and develop revenue today, right? Because they took a lot of the processes that were in the centers and took them out into a digital world. They created the customer base for immediate surgical procedures when the centers were ready to reopen, to try to maximize the cash flow and revenue opportunity for those centers early on. And believe it or not, people are coming back. And of course, they had to create procedures to create a safe environment for the doctors, the employee, the staff, and the patients. So it's about hard work to address all these issues in an uncertain world, and to be very cognizant. We talked before about management and about boards. These are the questions that they need to be continuously focused on and answering, and not be complacent about on all these topics: suppliers, customers, you know, environment, processes, and the like. So I mean, more questions than crystal ball.
Yeah, for me, Abby,
go ahead, Andrew.
You know, for me, I think eventually, as a society, we're going to find through technology and healthcare, you know, we're going to find a way to, you know, deal with and handle COVID. And I don't see the current environment, you know, I call current environment, you know, I call that, you know, 3 to 12 months from now. You know, I don't see that being the long-term norm. And so for me as an investor, I want to sit down and you know, take the tools that we have and determine, you know, A, to the best of my knowledge, what is that, you know, that time frame going to look like, and B, what are the fundamental business models that are going to change during that time frame, and then you know, take a position relative to you know, what businesses will be able to survive through that environment and that timing of the environment, and you know, what liquidity and the tools that they need to survive. But for me, I think fundamentally, you know, I can't tell you yet if it's going to be 3 to 6 months or, you know, 12 to 24 months. And I think that fact is what's slowing the level of deal activity and deal restructurings. But I do fundamentally believe that as a society, we're going to get back to a new normal that isn't going to, people aren't going to change. At some point, people's habits won't be based on what COVID is. I think it'll be more like what the flu is today. And, you know, being able to predict A, the timing, and B, how that fundamentally changes business models will be where, you know, people will be able to thrive, both businesses and investors will be able to thrive.
Thank you.
I share Andrew's optimism. I think, though, we have a pretty punishing 6, 12, 18, 24 months ahead of us, where what will be important is resilience, is proactively looking forward to what your customers want from you and how you're going to be able to provide that at a cost and quality that they're willing to pay for. And I think businesses should be more holistically aware of their effect and their accountability to all of their stakeholders. I think the suffering that COVID has imposed will shock people into being more thoughtful about the effects of business. So in addition to everything Bill said, which is exactly right, all of those, management has a ton to think about. The big picture, I think those are the things that good leaders need to be focusing on as well.
Luke, the final word?
I'll keep it short. I mentioned this already, but as we always tell all our management teams, it's going to take twice as long as you're planning and be 2 times as expensive. So plan on it now. I'd say, you know, in the new market in regards to the credit side of things, over the next 6 to 12, 18 months, focus more on flexibility and structure than pricing. Might be a bit biased, but focus more on flexibility and structure so you can get through and be, you know, less conscious on pricing. But then again, you know, I agree with what everybody said. I call me crazy, but I believe people, humans, you know, suffer from various forms of dementia, and are creatures of habit, and we'll be back to normal in probably 12 months, to be honest. I just, you know, there will still be repercussions on an economic perspective, but I think we'll be back to normal sooner than we all think.
Wonderful. Well, thank you all. This has been a wonderful conversation. And to our audience, thank you for joining us. And if you'd like to, you know, connect with any of our panelists, if you need a lender, an equity investor, an advisor, or a CEO, we have great ones here. So feel free to reach out to us and we're happy to connect you. Everyone, take care, be safe.
Thanks, guys.
Thanks so much.
Thank you.